By convention, this should have been a vote on account or an interim budget, but it looks like there's a possibility that we will continue to see some sort of policy statements come through at the start of February. So what we're doing is judging two things: whether we'll be able to meet the fiscal numbers for FY19, and we're judging whether we should be expecting any large policy changes. Joining us for a conversation on both those aspects is Abheek Barua. He is Chief Economist at HDFC Bank, joining us from Delhi. Abheek, a pleasure having you here on Bloomberg Quint. Thanks so much for taking the time to speak to us. I'm going to sort of split this into short-term issues and slightly longer-term issues. So let me start with the first. I noticed that in your report, you expect the government to meet the 3.3% fiscal deficit number. Although based on the latest round of CGA numbers that came in, it didn't look that optimistic.
It certainly doesn't. I think our forecasts that you're referring to are a little dated. And while there could be, large receipts in February, there doesn't seem to be any indication that things like, say, the Bharat ETF or some of the strategic sales that we are factoring into our numbers are anywhere close to fruition. So, February and March, there's a huge question mark over what the government does and manages to achieve in February and March. Having said that, I am reasonably convinced, despite the current run rates and the lack of activity that I just referred to, that the fiscal deficit numbers will not exceed maybe 3.5%. And my sense is that 3.4 is pretty much the maximum slippage the government will allow. There are various ways to do this. You cut back expenditure, you delay expenditure, you delay refunds, and so on. It's a cash-based budgeting system, so these things are possible. So I think while there is possibility of some slippage, it's not going to be very large. And certainly the bond markets are not showing any signs of real panic at this stage.
Abheek, so even if the slippage is small, 10, 20 basis points, how would you see it coming on the back of an earlier year where again you'd slipped on your target? So, forget 3, which I think, we'll parked it for a much later time, a 3% fiscal deficit, but you've slipped 2 years in a row.
Right. Well, I think there would be two views on this. One is the sort of the conservative Washington consensus type of view, which the IMF and the rating agencies share, that you need to have perfect fiscal marksmanship. On the other hand, given the fact that you have a completely new tax regime in place, which is bound to have teething troubles, and there are critical expenditures that are imperative, for instance, on the farm sector and so forth. One should allow some degree of freedom. Now, the government will have to walk a fine line, between these two somewhat extreme views, and so a small slippage is what is going to allow. My opinion is that we need to have some degree of flexibility. Otherwise, in order to meet the target willy-nilly, what we end up doing is a lot of very creative accounting, which automatically kicks the can down the road, and these problems resurface in the following year. But of course, the pats on our backs that we've got from the IMF might not follow if we slip in 2 consecutive years. But I think it's not entirely undesirable. And I think that there was a healthy debate that Arvind Subramaniam was starting on this issue, that if you can justify the slippage in the deficit in terms of its necessity or the quality of spending, we should not be bound by these very stringent numerical targets that we scramble to meet through all kinds of innovations towards the year end. I tend to take this view, but certainly there would be some sort of warning shots being fired by agencies like the IMF, rating agencies, and so on. What their credibility is at this stage, remains to be seen.
Sure, Abheek, that's a much larger debate. But let me ask you about some of the individual numbers there. GST in particular, what have you made of the fact that we haven't gotten in a sustainable fashion to above that 1 lakh crore mark? Still teething troubles, or there are structural issues that need to be addressed?
Well, I think there were teething troubles that have been addressed to a degree. I think there are problems with refunds and so on. The IT backbone is perhaps not as robust as we had assumed. What interests me about the GST numbers is the fact that there is such a large variation across states, and states that you would have expected to have not performed so well in terms of compliance and general tax administrations, like Bihar, have actually done very well. And Bihar leads Karnataka, whereas Himachal Pradesh, which scores very well on other governance counts, is very low on the list of GST performance in terms of being able to meet the targets. So I suspect whenever I see interstate variations, I suspect there are governance problems, perhaps something to do with the specifics of the the compliance, the infotech infrastructure, and so on. So I think we'll have to look at it in terms of improving administration in these specific states. Clearly this year has been a disappointment, but I think we are past the stage where we can excuse these slippages as teething troubles and look at the problems more carefully. And I suspect the problems are state specific, and administration needs to be tightened in states which have underperformed significantly. There are quite a few large states in that list.
That's on the tax side. On the non-tax side, I think you already referred, the problem this time around will come in from divestment most likely. Last year around, the shortage was mostly on the dividend side. Is there, I mean, we don't have much time, but would you guess that there would be a large component of an RBI dividend which would be required this time to balance the budget?
I would suspect so, because I think where there is pure, financial engineering of sorts involves, like the PFC REC deal, it'll come through. But strategic disinvestments of the dredging corporation, for instance, which is there on the list of divestments, I don't know what kind of progress we've made on that, and ditto for a number of other companies on that list. Bharat ETF, if you just look at, which they are going to sort of again aggressively sort of relaunch in February, has been an underperformer of the market, and I'm again not very sure of what interest there'll be. Having said that, there is always there seems to be institutional interest, both domestically and from foreign investors, in good quality Indian public sector funds. But I agree with you that there is a large residual gap that needs to be filled, and perhaps that has to come from dividends from the RBI, perhaps some more dividends from the PSUs. I don't know how that's going to be structured. And there can be fairly drastic cutbacks in expenditure by simply deferring some expenditures to the next year for some ministries. And some ministries, including ministries which I thought should have performed well, like railways and agriculture, have actually been laggards in terms of using up the allocated funds. So that opens up some room. The compensation cess which is there with the government, which is imposed on customs tariffs, that I think gives them a little bit of a buffer. So net again, I sort of arrive at the conclusion that with a little bit of help from the RBI, some amount of financial jugglery, some genuine savings, some deferrals to the next year, we should get a number of close to 3.3%. It might exceed it, but not by a large quantum.
Okay, Abheek, let me shift to the policy side. And in this whole debate about some sort of farm support package, I'm continuing to ask people whether they're convinced that this farm support package is needed or not. First question is that, because even the indicators are throwing up different points. Yes, if you look at food inflation, there's a huge red flag coming out of there. But you listen to somebody like HUL reporting their earnings, they are showing good underlying volume growth. They're saying rural is growing better than urban. Are you convinced that there's a need for a farm support package?
I think there is. I sort of I've heard similar arguments and so forth, and the FMCG companies are doing well. But again, within the FMCG companies, among the FMCG companies, and I'm digressing a little here, if you look at the big players versus the regional brands have actually started doing much better than the bigger players, which could suggest some degree of down trading, which happens when incomes suffer. But my hypothesis is that there, because of various factors, various structural factors that sort of underpin the Indian agricultural sector, the fact that richer farmers in the north and west have more access to the procurement apparatus, have seen sort of a quicker impact of farm loan waivers, etc. I think there is a fairly large degree of inequality that has emerged in the farm sector and perhaps in the rural sector as a whole. Now this has been exacerbated by the fact that Manrega has not been as operational as in the past, which is reflected in poor farm wage growth, which leads me to believe that yes, there is distress in the farm sector, but one should distinguish between distress and just farmers' discontent with the state of things. And so if there has to be a package, it has to be focused largely on the distress, poor farmers and agricultural workers who often play a dual role of doing a little bit of farming themselves, and somehow ensure that the larger, richer farmers don't hog the bigger share of the support program, and that I think is critical to ensure. Things like the increasing the MSP, increasing procurement through private traders, etc., doesn't seem to be working too well. And of course, farm loan waivers are much worse than having even a universal income support program, because you don't sort of destroy the credit culture with the latter. But I personally think, to cut a long story short, that the farm distress is genuine. It is confined to the lower tiers of the agrarian population. You are seeing numbers which are strong for the FMCG companies, perhaps because of the better off farmers. and we'll have to look at the portfolio of HUL and other companies very carefully to see which of their products are doing well. And yes, some kind of relief is needed for the lower income tiers of the agrarian sector.
Okay, so if it takes the form of an income transfer, like you're saying, perhaps conceptually you wouldn't be opposed to it, then it would come down to the financing of it and what gets subsumed within that income transfer, if that's the shape it's going to take?
Absolutely, absolutely. Yeah, that's the bit. So, I mean, I think it's really a kind of a mini UBI, Universal Basic Income Program, that you're operating, and the viability of any kind of an income support program is contingent on the ability to subsume the extant payments into this consolidated transfer, and that applies to the farm sector package as well. If you continue to give them all sorts of subsidies and have an income transfer, you would perhaps create both severe overheating in the economy and lead to a complete fiscal mess. So but taking away some of the more visible payments and subsidies is politically difficult, but I think the package will have to be communicated to the farmers effectively.
Won't it be toughest to take away the interest subvention? I'm just sort of asking out of curiosity, because people will then have to start paying the real rate of interest on some of these loans, which I don't know how well it'll go down.
Yes, I think that's the problem. I mean, if you have certain things in place which are visible, it's difficult to take these things away. So perhaps some of the things that might lead to these controversies, or actually increase the level of discontent among farmers, will perhaps need to be kept out of this of the consolidation ambit, and be allowed to continue. Because it's very difficult taking away something like interest subvention and still convince the guy that he's better off with an income transfer.
All right, Abheek, just moving away from this, because actually, to be honest, none of us know the specifics of what's going to get announced, if anything. You'd mentioned earlier that the bond markets have been reasonably, okay. There's no panic reaction on the bond market side, either on the fiscal deficit potential slip or on this scheme. Is part of it also to do with the fact that some of these borrowings are now getting directed into the NSSF? You talked about that in your report, at least the last one that I read, on the increasing reliance on NSSF?
Certainly, but I think that has been a continuing theme. So if there was an overshoot, there would be the additional amount would be split between the NSSF, which is already bearing a fairly large share of the burden, because if you look at the market borrowings to fiscal deficit ratio, it's come down all the way to 59%, which means there's a heavy reliance on the NSSF already. And if the markets were really panicking, I don't think they would have, if the markets really anticipated a slippage in the fiscal deficit, I don't think they would really sort of sit tight and tell themselves that, look, the NSSF is going to fund it. That's always the anticipation of additional borrowings if there is a serious risk or a perception that there will be fiscal slippage. That doesn't seem to be happening. The NSSF certainly has played a role, but it's sort of a continuous thing which has sort of panned out over the year. And will continue to do so, because states are no longer drawing down that much from the NSSF pool.
Okay. Abheek, my last question to you is, so a little bit broader than just the budget. So potentially, if we have some sort of a stimulus coming through for the farm economy in the budget, that's, fiscal stimulus, there is also the possibility that you could see rates being cut at the MPC. Firstly, I'm keen to know whether you think that we'll see a February rate cut or not. But if we do, then you have a scenario where you're moving into looser fiscal policy, looser monetary policy when core inflation is high. Not the easiest of, positions to be in.
It's a bit of a dilemma, and I think looser fiscal policy does not mean large fiscal expansion. I think we need, I don't really think, monetary policy and fiscal policy always need to be in opposition. And I think we are in a scenario where we are sort of not doing too well on growth. There could be a bigger slowdown going forward, especially since the global economy is looking weak, and that will sort of impinge on both exports and capital inflows. And we have spectacularly low inflation rates. And this was not just specific to India, but to emerging markets as a whole. And I think we have an index for emerging markets which shows inflation at around 2.6% for the PAC as a whole. So in this kind of a situation, whether a slightly a monetary policy that responds to inflation and does not over-fret about a possible fiscal stimulus is perhaps desirable. I am not very dogmatic about this constant need to create a tussle or an opposition between monetary policy and fiscal action.
Are you expecting a rate cut in February? Sorry, out of syllabus question, but are you?
I think they should. I mean, I invariably go wrong on my predictions because I tend to get carried away by what my take is. But I think, this monetary policy thing has become so much of a ritual. I think they need to cut rates now. But, if the postponement or the delay in a rate cut is justified by the fact that they need to change their stance and then wait and watch, which is a popular phrase these days, and then cut rates, I think we might just miss the bus or boat, whatever the expression is. So I think they should both change the stance and cut the rate in February, and I have a feeling they will this time.
All right, Abheek, thank you so much. It's been a pleasure speaking to you, getting your views in the budget, some possible policy announcements. Thanks so much for joining us.
Right, yeah.
All right, that was Abheek Barua of HDFC Bank. Our view on budget numbers, possible policy announcements, and a last word there on monetary policy as well. Thanks for watching Bloomberg Quint.